What are you doing? Not again.
Don't steal from your bank. I mean, come on. If you guessed what we're going to talk about today, that's good. We're going to talk about not stealing from banks. But we're specifically going to talk about why you shouldn't steal from your own private bank. I mean, if you steal from a bank, you get arrested, right? So what does that mean, your private bank? Well, if you created a banking system, which we're going to talk about, would you steal from your bank? Of course not. At least that's what you say, but people do this all the time. They start their own private banking systems. They take loans from their own private bank to buy cars and vacations and all sorts of things. And then they just steal from their bank. They don't put the money back in their bank. They literally let the extra money just go to somebody else's bank. I can't freaking understand why you would do that. You might as well just put the mask on and go steal from a real bank. And well, hopefully you don't get arrested because it's the same darn thing. Let's get into that. Along with this topic, I've got a special guest. A guest that I had on this YouTube channel to do a case study, and she's actually applying this. So, welcome, Shauna.
Hi guys. So a few years ago, I planned out like a case study to use my cash value for my Disney trips because I didn't have tens of thousands of dollars in my policies. You know, it was just small amounts, and so this was the thing that I came up with to use my policies for. And I just wanted to check back in with you guys, show you how it's been working so far and not stealing from the bank. And you know, as my cash value grows, I can now get into other things.
So let's dive into this. So when we talk about a private bank, we're talking about what Shauna, myself, and over 7,500 people in this country alone have done, just from us. I'm talking about building a private banking system using not a traditional bank, but using a whole life insurance policy from a mutually owned company that pays dividends. Now, before you go getting all silly like Shauna got silly until she started saying there's something to this. I'm not talking about the regular whole life that your brother-in-law tried selling you at Thanksgiving. I'm talking about a specially designed and engineered whole life policy. One that's designed to be used with a process called the infinite banking concepts. So most of you watching this, if you take a vacation, how do you pay for that? Some of you might be like, I saved money in the bank account. Sean, you've done that too, where you've saved money and then you got a goal and you spend that cash on that. But that means that money has not been working for you the whole time it was being saved. But most people in today's world, they just pull out the credit card and they swipe the card, and that's how they pay for the vacation. And then some have a plan, like Shauna, to pay it off over the next 12 months, or maybe you pay it off in the first 30 days, or maybe you're just a hope and pray kind of person and maybe you'll pay it off, but hey, the vacation was pretty sweet. But what we want to look at is, would you steal from a traditional bank? In other words, if you used a credit card to pay for your vacation, would you just stop paying that credit card payment?
No.
What would happen if you did?
I'd get fees and my credit would be messed with, and I wouldn't like that at all.
Well, they certainly wouldn't come and arrest you, but your credit would get dinged and you wouldn't probably be able to take another vacation using credit cards for a very long period of time. Right. And probably wouldn't buy cars, snowblowers, go-karts, motorbikes, any of those fun things you like that you finance. So you can see most people, when they use a credit card, they are always making monthly payments. And what is the interest rate that they pay on that? How much is your interest rate on your credit card?
Some of them are 27 to 29%.
So if I said you had a credit card at 15%, we'd be talking about a really good credit card.
Right.
Yeah, how about any of you? You guys got credit cards at 15%? Some of you might, but most credit cards with what the Fed has been doing are upward of around 24 to 29. I just saw, did you know that credit card companies can charge you almost any amount that they want?
I believe it.
Well, I didn't until I read it the other day. But anyway, let's get back on topic. So what I want to show is I want to show two scenarios. So we're just going to assume that finding a credit card at 15% would be a pretty good credit card because of what the Fed has been doing. Most credit cards are north of 20% right now and going higher as we speak. So how we're gonna do this, Shauna, is we're gonna look at 2 different scenarios. Actually, let's look at 3. Let's look at you save money in a bank account and then you just take that money out and you pay for your vacation. Some of you probably do what Shauna maybe would have done. Then we're gonna look at paying with a credit card like you were used to doing. And the last one we're gonna do is we're gonna use your private banking system that's specially designed and engineered whole life. We're gonna take a loan from the whole life, pay for your vacation, and you're gonna make the exact same monthly payment that you would pay on the credit card. Fair enough? So it's exactly the same dollar amount, but we're gonna see which one would be better. How's that sound, folks? But before we get into that, what I'd love to do is have you all help me rob a bank. I'm just kidding. Let's actually have you help me subscribe to this channel. So click that subscribe button, and right up above, there's a little bell. Smash that bell, and you then will receive notifications every time we put up a new video. So what I did, Shauna, is I put together a couple scenarios, some fancy spreadsheets, if you will. And we're also going to take some information from a government website to show you what compound interest looks like. And we're also going to use another one to show you what your credit card calculator would look like if you're going to pay it off. We're going to use the same dollar amount. So Shauna just took a vacation to Disneyland.
Disneyland, yep.
Disneyland. I always screw up world and land. But she went out to Disneyland. It looked like an epic trip. How much was that trip?
Between flights, hotel, tickets, and spending money, it was $35.35, so $3,535.
So $3,000 and some change. If we were to use a credit card on that, at a good credit card rate of 15%, your payment, because you said you would make more than just minimum payments, right?
Right. My plan is to always do it within 12 months because not every year, but sometimes we do this trip like every year around the same time. So it's more advantageous for me to not be juggling 2 trips at once. So like I want it paid off by that next year.
Oh, I like that. So she's planning on putting it on a credit card, but making sure that credit card's paid off within 12 months so then she could take another vacation. Sound good? So if we figured that out, the payment would be $338.81. And if she used a credit card at 15%, paying that balance down every month, never stealing from her credit card company's bank, she'd pay that thing off in 12 months. But that would also cost her $276.43. So $276.43 would be the cost of just the interest that she'd give to the credit card company. How's that sound?
Not great.
But not terrible, right?
Right.
Some people are like, it's only $276. I make that in a couple days, hours, minutes. I don't know where you work and what you do, but hey, that's what you would pay. So is that the best option? Now, some would say, yeah, but I get credit card points and miles. All right, great. So how about this? How about, to get the points on that, what we're gonna do is we're actually going to put it on the credit card. But within the first 30 days, we're gonna take a loan from your private bank and pay off the credit card. Because I know some of you are like, I still want the points. So let's get you the points, right? Do you use credit card points? Great.
Yeah, absolutely.
So maybe the flight will be free. So we're using the credit card. You're gonna get the points. Get this hood down. We're not going to rob banks. Hey, real quick, shameless plug, sorry. But we're now making beanies or toques for all you northerners. And then what we're going to do is we're just going to slap our little BYOB. So if any of you are interested, stay tuned. You can go to chrisnaugle.com, go to the shop, and you can get yourself a toque, or some of you call it a beanie, or whichever way you go, a little BYOB action. So then you're ready to go steal a bank, or actually just kind of ponder whether or not you should be stealing from the bank or not. So let's just recap real quick, Shauna. There's 3 ways you can take this trip. Number 1, you could save the money in the bank, okay? Which we're gonna hit in just a second. Okay, number 2, you could pay with a credit card, which you like because you get points. Or number 3, you could pay with a credit card and then use your own private bank to pay the credit card off, so you pay the credit card companies nothing, but you pay your bank back the same amount. Okay, those are the 3 different things we're gonna do. But first, let's just look at the bank, right? So if you had $3,535 in a bank account earning 4%, that'd be a good bank?
Yeah, sure.
Okay, so 4% on $35.35 sitting there works out to be about $11.78 a month. That's about $141 a year. Now, not bad, pays for a couple Starbucks, right? Okay, but we can't have it in there a whole year because you're going to take vacation. So really you're only going to get about 11 months because then you got to take it out and use it for the vacation. So that's still better than the other scenario, but you still don't make much. And every time you take the money out to pay for the vacation, you stop the flow of compounding, right? Your money no longer can compound until you save it back up. Okay, so that's the first way, folks. So the second way would be to use the credit card, but you all know what that looks like. We already went over those numbers, but just to give them to you again, it would take 12 months of making $338.81 payments on the credit card to pay it off, of which you'd give away $276 in interest to the credit card company. You guys seeing that? So if you had the money in the bank, it'd make $141 at 4%, but paying the credit card at 15%, you're gonna give away $276. So already the credit card's not looking so good unless you really like those credit card points.
Right.
So do you like those credit card points enough to cost you about $135?
Not really.
Because that's the difference between the interest you'd pay the credit card company and the interest you'd earn on a bank account.
Probably not.
Now, people do this all the time. Literally, people will have money in a bank account just sitting there and they're saying, oh, because I got a high interest rate savings account earning 4, maybe 5%. And then they've got balances on their credit cards that they use because they wanted the points and they don't pay those credit cards off with the money sitting in the bank. Are you one of those? Are you?
No.
Good. Are you? So now what we're gonna do is we're gonna go to the third and I think the best way. So first off, your vacation. You're gonna swipe the credit card. What's that gonna get you?
It's gonna get me points, cash back.
All right, so points, cash back. Great, so we're gonna use the credit card, but we don't wanna pay the credit card company any money. So what do you gotta do?
Pay it off immediately.
Right, you're gonna pay it off immediately. Okay, but you've been saving money in the bank account because we didn't change that. So you kept saving that same amount of money, which works out to be $338 and change. That's what you're saving. So here's what we're gonna do. We're gonna have that money saved in a private banking system, one of those specially designed whole lives, which you have one of those, right?
Right.
Matter of fact, actually, what we're talking about right here for the third option is exactly how she just funded her last Disneyland trip. So this is real. When did you get back from that trip?
Like last week, last Sunday.
Like last week. So this is fresh, folks. So what she did is she used the credit card, but then she went into her policy and took a loan from her policy and paid the credit card off. How much does your insurance company charge you to take a loan from your policy?
I think it's 5%.
5%. So she's gonna pay 5% to the insurance company, but it's simple interest, kind of like what a credit card would be. However, the full amount, the $35.35 in cash value that she technically took as a loan is still in her policy. So here's the thing you may not know. When she took the loan from her policy, she actually didn't take any money out of her cash value. See, the money in her cash value, that $35.35 that we talked about, that just stayed in there earning compounding interest. Now, what's your interest rate and dividend that you're earning from the insurance company? They charge you 5, but what are they paying you? 6, right? So you're making 6 and they're charging you 5. Okay, I just want you to know the numbers. So her money, the $35.35, is still earning compounding interest, but she still got access to use the $35.35 to pay off the credit card. And that cost her 5% simple interest. So I want you to understand something. One is going up, compound interest. One is going down, the 5% simple interest loan that she's gonna pay back because you're not gonna steal from your bank, are you?
Nope.
Okay, so she's gonna make that $338 a month payment that she would have given to the credit card company to pay it off in 12 months. She's just gonna pay that exact same amount back to her policy as a loan repayment. But here's the cool part. You already know this, so can I just share it with them?
Yeah.
All right. So when she makes that $338 payment every single month, how much money does she have every month she makes that?
$338.
She has $338 more. Remember, her money never left the account, it's compounding, but every loan repayment she makes back to the policy is $338 she has to use immediately after that check clears. Try that with the credit card company or try that with any loan at a bank. Like you make a $338 payment and then you just want to take that money back. Now, in a credit card, you might be like, well, yeah, if I do that with a credit card, I could get that money right back. Not if it was interest-only payments, but you get the drift. So every payment she's making back to her policy is money she has to use the next day. However, she never stopped the compounding effect. But here's the other thing. You see, when your money is earning, it's going up, compounding, but the balance on the loan is going down. You took $35.35 out, but you're paying back $338. So check this calculator out. This is really cool. So if we make $338 payments back to your policy every single month, you would pay this loan off in 10 months, not 12, because they're only charging you 5%. So if you paid back the same amount you would have paid the credit card company, which is 15%, you get to keep all that interest too, which works out in 12 months to be you got an extra $526. That's just money that you paid yourself back instead of giving to the credit card. And not only that, her money, the $35.35, kept earning interest and dividends, which I don't have the exact amount, but you remember the compound interest calculator? So we went right here to investor.gov. They have a compound interest calculator. So that means her money in her policy, if it was compounding, hypothetically, would have grown to roughly around $36.76. So that's another 100 and change that you earned there on the policy. Plus you got a death benefit, plus all that interest and dividends you earned in the policy, earned money tax-free, because obviously it was in a tax-free environment. Now, not all whole life policies are done in a tax-free environment. You have to be designed and engineered so that they don't MEC. Now that's a IRS code, it's called the MEC 7 pay. You don't have to worry about that if you use us to set up the policy, which Shauna went through, well, clearly, obviously went through us to set up her policy. So it's designed and engineered to not be taxable. What that means is she doesn't have to pay tax on that gain that she earns on the cash value. But anyway, that's boring stuff, right? But so let's just sum this whole thing up. You got the points on the credit card, okay? And cash rewards, I believe. Not only that, you got to take a really cool vacation to Disneyland, okay? Not only that, you got all the money back to the tune of $526 extra in 12 months, and your cash value grew by 100 and change.
Yeah.
So that sounds like a pretty good solution, right?
It does.
And what really changed for Shauna, folks? Did she save any more money? No, nothing. Exactly the same amount she would have saved before with any of the other options, except for she controlled her money. Not only did she control her money, she controlled the flow. But here's the best part. I know all of you are hung up on that 5% that you got to give to the insurance company. Shauna didn't give the insurance company 5%. Because remember, she was paying the balance down. And the way the insurance companies calculate the interest, every time she made that payment, it reduces the amount she's paying interest on. So it's always going to be 5%. But after 12 months, do you want to tell them what your effective interest rate was? Your interest rate you paid, what was it?
3.21.
So she only paid the insurance company 3.21, while her money continued to compound interest and dividends at a rate of 6%. Do you understand how that happened? See, she didn't steal from her bank. She made the same payments she would have paid to the credit card company back to her policy. And because she was an honest banker, not stealing from her bank, she was able to save a bunch of money in interest to the insurance company, which I know all of you are like, oh, why would I ever take my money that I saved and then pay it back? Because that sounds stupid. Stupid is as stupid does, as Mr. Forrest Gump would say. She only paid an average of 3.21. How do we figure that out? We added up the APR on that loan to the insurance company every single month, and we just divided it by 12 months. That's it. So now you can see why being an honest banker and not stealing from your bank is advantageous and makes more money for you, because she paid that off in 10 months, put an extra 500 and some bucks in her pocket, and all the extra cash value growth from compounding was still there. High five. Folks, this is what I'm talking about stealing from your bank. You don't ever want to take money from your policy, go on vacations, buy cars, do whatever, and then not pay your policy back. Because you're like,
oh, well, it was my money to start. I saved that money, so I'm not going to pay my policy back. I don't even have to. The insurance company doesn't ever ask me for it back.
Indeed. The insurance company doesn't care if you ever pay that loan back, because they just advanced you part of your death benefit. So if Shauna were to pass away, I'm not going to jinx you, on the plane ride back from Disney, the insurance company would just subtract that loan from her death benefit that's paid out to her beneficiary.
If you look on Chris's YouTube channel, you can find another case study where we did this in theory, a few years ago, but I've been actually applying it. And now this trip specifically, I was actually able to use my daughter's policy. Oh. So my daughter Harper, her policy was the one that I actually used, whereas like a few years ago, it was my own policy that I was using. But I have so much cash value grown in my policy now that I'm using mine for more investment type stuff. And then I'm able to take the trips and still do the same thing with, my daughter's cash value, because I put about $2,500 a year in a policy for her. And we're both on our fourth year. So time is your friend with infinite banking, so yeah.
So with your policy, you're flipping forklifts, right?
That's right.
So she's actually taking the money in her policy and flipping forklifts. Which brings me to another thing. At the end of this video, I'm gonna reference another video you should watch. Watch the video of how Shauna and myself are flipping forklifts. That might give you some good ideas on how you can pay for even more vacations just from the profits of those stupid flipped forklifts. Pretty cool stuff.
Yeah.
With that being said, folks, thanks for joining us for this episode. And also remember, never steal from your bank. I mean, they shouldn't steal from anyone's bank, right? Because they'll go to jail. Yeah, all right, well, unless you need a free meal, don't steal or rob a bank. And don't steal from yours. We'll see you on the next one.